and my take on it is one, anytime you create a new product or a new strategy out the atmosphere of from the sky, and try to just do back testing um from this point, and the back testing doesn't add any of the real factors of life into them. It's a perfect world back testing. So
Yeah.
anytime you do any perfect world back testing, you can manipulate anything to
Yep.
make it say anything that only time is only going to reveal. And like we say all the time, like if you study like the IUL is a baby in comparison to all the other financial instruments that have been out here that's been proven or
Yep.
disproven over time.
Yep.
And I think the stuff is crazy. And to take a policy, to pull money out the policy, to start another policy, to pull money out that policy, to start another policy, to then pull money out that policy, to start another one, so that you can get this positive arbitrage. You can spend more time learning how to build a business.
But you know what? He's making commissions every time you do it.
And that's honestly, I'm just gonna say it. I think Mutual of Omaha is a piece of crap for even allowing it. I'm just gonna say it. You ain't have to say it. You got enough on your plate.
I think they're going to be liable ultimately at the end of the day when that all comes.
I hope they are. I hope they are.
I think
because that's nothing but greed. They see him.
Yep.
They see that as a policymaker. They see that as a policymaker to be able to do it. And I'm gonna just say this. Colin asked, which scares us the most. What scares me the most is the damage that it's going to do to consumers. Like it's not even about who's right. It's about the consumers that's getting beat up. It's about the consumers that's getting beat up in the marketplace. And you remember when the UL first came out, pretty much everybody's UL bottomed out. Yep. And then they had to create this new version of the UL in order for it to make it happen, which is just the scariest thing on the planet, really.
Totally. Well, you know what, to Colin's point, my biggest fear is the spread rates and the fact that they're using indexed loan options, and caps can go up, they can go down. I mean, I think they're going to go down or remain pretty close to where they are now. But when you look at the way that the loans work in utilizing the relock, you're never paying the loans back, so the loan expenses are compounding against you, right? And so that works when you
with the cap rate dropping.
Yep. But that works when you illustrate 50 basis points of positive arbitrage. It looks really sexy on paper, but in real life, I mean, life doesn't exist on that spreadsheet and in that calculator. And so, what happens is as years go on, and let's say you're contributing $10,000 a year for premium, and then 3 years later, you borrow against it and you got 10,000 more for another premium. And then next year, do the same thing. And you just keep stacking these policies. Within 20 years, you're going to have literally millions and millions of dollars of policy loans, because the compounding of everything is going to work against you. And so what happens is one negative year and you have a 5% loan rate, one negative year, you got $100,000 of interest expense on $2 million of policy loans that the policy then has to be able to support on top of the cost of insurance, on top of the admin fees, on top of everything else. And that's why these policies are going to have so many problems. Like the sad part and the scary part about that is the people that are participating in this MPI thing, in my opinion, are not going to know how bad off they are until it's too late. And here's the thing. I love it when regulation proves me right. I love it when regulation catches up and finally puts in place rules that back up everything I've been saying for the past 5 years. Right?
And let me just say this real quick, Chris. Talking about regulation, right? It's always easier to pull wool over somebody's eyes when there's no regulation. Let me tell y'all why regulation is regulation. Because somebody finds a loophole. They exploit the loophole for their personal benefit. Mm-hmm. Then they claim that this is the reason why they're winning. Go sell that same thing to a bunch of people that's getting screwed over. And then the regulators got to come in and put iron fence, an iron fence around the idea, and somebody's going to go to jail and somebody's going to have to pay for the losses. I'm not saying that they are, disclaimer, but what I am stating is that typically that's exactly what happens. And so just because somebody, let me just tell everybody this, especially when it comes to you building your wealth, your wealth triangle or your wealth foundation.
Yeah.
First of all, keeping it simple is the simplest function. The purpose of your policy is to be a warehouse where it stores your cash.
Yep.
It keeps up with inflation so that you can keep your purchasing power and you have the ability to leverage against it while protecting the number one asset in your life, your body, your ability to make money. It's simple as that. The policy is not supposed to be used as this machine that makes you rich. It's a machine that keeps you rich. It's a machine that keeps the capital where it's supposed to be so that you can go and do what you need to do. And I'm just going to be honest with you. Like, to get 5 policies or 10 policies to do all this other stuff, most people don't even have 5 bank accounts. let alone 5 MPI policies that are quote unquote reloaded it's ridiculous to me. And the amount of time that you have to spend to watch all you got to really be a connoisseur in this insurance game in order to come out alive in any policies like that, let alone God forbid, Chris, you go life's you lose your job, you got a business, you lose your clients. You have babies, you have a death in your family, you go through depression. God forbid lives. And when it comes to life insurance, it's supposed to be simple, easy, understandable. The flow is supposed to be just right. And it's not supposed to be a product with all of these complexities to it, which actually makes it just as difficult or just as confusing as all these other financial products that are not making people money long term.
Amen.
Period.
Appreciate it. You just had a mic drop.
Period.
That's it.
So let's talk about a couple of things. I gotta talk about a couple of things. You talk about
you bring it.
So my biggest issue, and you know this, Chris, and I'm gonna keep saying it. I want our clients and I want our viewers, and our smoke kings and queens to start doing this. If you run into an agent that is practicing private banking, ask them to show you their private banking strategies for their own life.
Yep.
It's simple. Like to me,
yeah.
This is just me. I believe that everyone that teaches the concept of private banking should be held to the fire and say, okay, you practice private banking. How do you implement it? How do you structure it? And how do you actually use it in your life? Not just selling policies.
Sure.
Chris, I had a Meritage literally just here 2 seconds ago.
Yep.
And when I was talking to them, I was telling them, listen, my clients got to go through a 36-hour mandatory training before we even accept them as a client.
Yeah.
Because you got to understand it in order for you to actually use it. It's not just about selling a product. If you're just going to sell an insurance product, all you go sell a term or something. Your pure insurance just gets them covered. You can't hurt anybody with a term. You can't hurt them. If you want to protect their money, ROP, give them a return of premium, get your money back. I'm a whole life guy through and through. But what I'm stating, Chris, is if you don't know what you're doing,
right.
Can sell. You can get you a return of premium term or a basic whole life insurance policy, and then figure it out from there. But to listen to these kids on social media that don't practice it, and these adults, these grown folk that are really children, get online just to sell because they're good at marketing. This in itself is not. It's not the place that we should be trying to get behind and follow behind like what people are saying are golden, and not asking them what if you're truly trying to help me with this concept of banking or private banking. I should be able to get examples of not only you using it in your life, but I should also get examples of the strategy that you're using that has been here past the test of time. Not something you created 6 years ago because you want to be the next 401k man. You know, you want to be the next superstar, because these are people's finances in their lives that are playing with. I'm sick of all of them, honestly.
It's so true, man. I mean, like, the bottom line is IUL, a lot of people like to tout the fact that IUL has been around since 1997, which, by the way, would still classify as a financial experiment. It's got no history of success. But it was 2009 that IUL.
I'm about to say, but does it?
But IUL really, I mean, 2009 is when it actually, you know, cracked the 5% market share for cash value life insurance. And from 2009 to today, I mean, it's done nothing but underperform, you know, its promises, not meet its promises to its clients, you know? And so like, when you look at that, you know, that's why I created the IUL challenge, right? No, I don't use VUL.
Nor do I.
So that's why I created the IUL challenge, is because, you know, it's just one of these things. Like, all of these IUL influencers, not all of them, 98% of them are 3 to 6 or 7 years in the business. They haven't been around long enough to see what these things actually do long term, yet they always want to talk like they know exactly what's going on. And then when I ask them to show me something and prove it, none of them are able to do it, you know? So it's a lot of talk. You know, it's like a big bag of hot air, man. It's like, and you know, they all work with these IMOs, and they have uplines that have been doing the business longer. So have your IMO prove it, have your upline prove it, have somebody. If you're in this and you don't have a mentor that can prove it to you, you might want to rethink what the heck you're doing.
Chris.
Yeah.
So let's help our people out, right?
Yeah.
Let's go over. Let's give them a list.
Yeah.
Of what to look out for in an agent. And when it comes to who you decide to practice this concept of private banking or infinite banking or whatever with. Let's give a list of do's and don'ts. I'll go first.
You go first. Yeah. We'll just go back and forth. This isn't scripted, y'all. We don't script this.
This is not scripted. Yeah, this is top of the dome. So listen, first thing.
Yeah.
Run away. If you get a if you get an agent that says it can't lose, it get an IUL and it goes up to the market. Oh, there it goes right there. Boom. Okay, there we go. You already had it. Number one. Yeah, listen, if they say that this product can't lose, it has a floor that protects you, and some of them even have the audacity, Chris, to say like a stop loss in trading.
Oh yeah, there's a product that I did, the Allianz product that I just did the review on. I did the full 55-minute review of that. Like, I went through all 55 pages of the illustration, line by line by line, and broke it down for people. And in that one, they have a 0%, 0.9%, so almost a 1% annual bonus. That's like a fixed rate bonus to be like, it's better than the 0% floor. We're going to give you this like bonus that's going to get you more. And it's just all smoke and mirrors, man.
So what's your one?
You know, so the thing that drives me nuts is the upside potential and downside protection conversation. So you just said you can't lose. So that's the downside protection, right? Like, you can't lose in a policy. But the upside potential conversation is basically saying, listen, this thing is going to let you participate in the index, right? So, and a lot of people say you're going to be in the index, but it's really, I mean, most agents are pretty good about that now. And it's like, you're going to participate in the index and be able to have upside gains. And, you know, when on negative years, you're not going to experience the losses. So you basically put that new floor, that new high floor in your policy. And it doesn't work that way, right? Like, it's because you still have the policy charges, you still have the fees, you still have the cost of insurance, you still have all these things that go into it, right? And once again, when you're young, while you're accumulating money in the policy, it's not that bad. And I can see why somebody that's been selling these for 3, 5, 10 years doesn't realize how bad it is. But when you get to retirement, I did on this one illustration, listen to this. The IUL had $164,000 of premium total over a 10-year period. And by the age of 80, there were $964,000 of charges on the policy. So that doesn't happen with whole life, by the way. I'm not even kidding. It's insane. It's nuts. I would encourage everybody to go watch that video if you want to learn the ins and outs of how these IULs work over the long haul, right? And so that upside potential, downside protection conversation, if they use that and they use it as a sales point, to me, it tells me that they're just trying to sell you into their, kind of get you caught in their web of how they're trying to get you to buy into the conversation, right? And to that point, I would say, I mean, Jake covered the downside protection because you can't lose to market risk, right? Can't lose to market risk because of the way that they phrase it. So it's all semantics and wordplay. It's kind of like Bill Clinton. I did not have sexual relations with that woman. Well, how do you define sexual relations, right? Like, I didn't lose to market loss. Like, how do you define that? Like, I could totally rip that apart and define it in a completely different way. Does that make sense? Is that a good? I think it's a pretty good analogy. I mean,
that was a darn good analogy.
But here's the deal. This is why I created the IUL challenge, is because we just came through the greatest bull run of all time. If your product gives upside potential, if IUL illustrations are quote unquote conservative numbers, why the heck are not every illustration coming through the bull run outperforming the conservative illustrations, and providing you upside? If you didn't get upside during beating expectations during the greatest bull run of all time, when the hell are you going to do it?